Hello and welcome. You're watching First Stick here on News9. I am Suyash Maheshwari and with me in the studio is Amit Ranjan. Let's begin with how the global markets are looking. Amit, over to you.
Thank you, Suyash. So it's been a green in the US, red almost everywhere else. Dow Jones closed almost with no change yesterday at 0.00% in the green. It had risen a bit. S&P closed 4.5% up. Nasdaq closed 0.62% up. 0.45% was S&P 500. 0.62 was Nasdaq. Coming to the European markets, they closed in the red at down 0.27%. Hang Seng as of 9:30 a.m. today was down 0.67%. Nikkei though is up 1.06% this morning. So,
all right.
Yeah, a mixed bag.
A mixed bag. And Indian markets, in fact, opened in the green today, this morning, with the first tick for Nifty coming in at around 21,477 mark. Now, the index has given up some of those gains, but it's still holding on to that 21,400 mark. And it was holding on to those levels as of 9:30 a.m. this morning. If we can pull up the numbers on the screen, you'll see Nifty is currently hovering just above the 21,400 mark. Sensex has recouped all its previous sessions losses and it's up about 120 points at 71,284 mark. The mid-cap index, which by the way, both mid-cap and the small-cap indices, they are pretty much on a daily basis scaling a record high. They have in fact scaled another record high in today's trade. Nifty mid-cap 100 as of 9:30 a.m. this morning was up 0.17% at 45,761 mark, whereas the small cap index has topped the 15,000 mark for the second time. It did top that 15,000 levels yesterday, but we were not able to close above it. Today, as of 9:30 a.m. this morning in the morning trade, we are sitting well above the 15,000 mark and at 15,028 sort of levels. Volatility index India VIX, which indicates what the future volatility is going to be like over the next few sessions, is at a multi-month high. It's just below about 0.23% lower, and it just sits below the 14 mark. So perhaps we need to keep an eye out for that. Let's also look at how some of these sectors are doing this morning. Now, Nifty Bank, remember Nifty Bank was a major mover in the December series. The banking pack has given a returns of about 8% or so before yesterday's fall. Since yesterday, that index has been under pressure, and we saw about a 0.5% correction in Nifty Bank yesterday. Today it's down by about 0.14% and it's currently sitting below the 47,800 mark. Remember, we did top the 48,000 mark, but now we are about 250 points shy of it. So look for weakness over there. Today is of course the expiry of Nifty Financial Services, so we'll keep an eye on for that also. And tomorrow will be the expiry for the Nifty Banking Pack. The IT pack, which saw some mild correction, we saw about 11% returns in the last 2 weeks, and the IT pack, saw some mild correction yesterday. The story is the same today. The IT pack is down by about 0.36% in the morning trade. Auto pack is also trading in the red, whereas FMCG, Pharma, PSU banks and realty stocks are trading in the green this morning. But with that, let's also bring on board Ms. Avni Bhatt, Senior Vice President at JM Financial. Hi, Avni. I think Avni is yet to join us, but let's look at the broader picture, Amit. In the last 2 weeks, Indian markets have risen by somewhere around 6.5% or so. In December alone, we are up 7.5%. Now, we don't see, there are years when we don't see this kind of a rally. Like, there are bad years where the market in the entire year rises by about 6 or 6.5%. We are truly on a on a Santa Claus sort of rally, as the market participants like to call it, because tremendous returns in the December series. And if we go back in time to jog back our memories, the rally started with the BJP's thumping victory in 3 state elections on December 3rd. So the markets reacted very positively to that, and we have since been rallying. After that, in the latter half of last week, latter half of the week prior to that, we saw some bit of a consolidation, and also earlier in last week's trade, because the markets had risen about 700-800 points in a matter of few sessions. So there was some consolidation that was needed. But then on Wednesday, Fed came out and pretty much said that rate cuts are in view, and by March they may be looking at cutting rates in the US. So that's what prompted complete 180 pivot for the global markets, and we are seeing a tremendous rally not only built in India but in global markets as well, where US markets are also rallying and posting strong set of numbers. But I think a word of caution over here. Mr. Powell did say that rate cuts are in the view, but since then 3 governors from Fed have come out and pretty much said that hold that thought, we are not even talking about a rate cut right now. There are other troubles, other problems that we need to figure out first before we can even look at cutting rates in the future.
Yeah, so the rally actually is very good news, and spoke about Santa Claus. At least he's looking at 2 markets with a bright eye, that is India and the US. I'm not too sure about Europe and the rest of Asia, but and there are not many any good news that is coming from the rest of the world. So despite that, if just by an announcement that there's going to be a rate cut and a little victory for a market-friendly party in India, if that is giving this reaction, then all good, at least at the close of the year.
Right. And Amit, since we were talking, the markets have in fact slipped into the red. As of 9:50 a.m. this morning, Nifty is now below the 21,400 sort of levels. It's currently hovering at around 21,379 mark. We are still defending yesterday's low, which was at 21,365. Today's low sits at around 21,367. So that becomes a crucial intraday support for us. As long as we defend that 21,360 to 21,350 mark, we can see further a pullback from there on. But as of now, the market has in fact slipped into the red. We are down about 44 points on the Nifty. BSE Sensex has also slipped below the 71,300 mark. The index particularly needs to hold above 71,000, which by the way, it had toppled on Thursday's session last week. Now, among sectors, from what I can see, let's talk about the broader markets first. They were trading in the green. Both of them have turned negative. Nifty Midcap 100 as we speak is down 0.27% and currently hovering around the 45,500 mark, whereas Nifty Small Cap, which remember had topped 15,000 mark, has slipped below it. It currently is about 22 points below it, flattish as of 9:50 a.m. this morning. Volatility is also coming down, which is nice, which is always good to see for the bulls. And India VIX as of 9:54 is down 0.97% at 13.77 mark. Now let's also look at the sectors this morning. And Nifty Bank, all the sectors in fact are trading in the red. It's only the FMCG pack that's trading in the green with gains of over 0.5%. And okay, I think Avni is there. Avni is joining us live in the studio. Avni, thank you for joining us here on First Take. Now, yesterday we saw a mild correction, but we were able to defend 21,400. Today we have slipped below that. It seems like we have not given much of those gains, so the market is kind of taking a breather over here. And what's your expectation? Is this kind of consolidation desirable at this point, given the kind of movement that we have seen in across the board in the last couple of weeks?
Good morning, Suyash. Good morning, Amit, and good morning to all the viewers as well. So yes, Nifty, if you look at the options data, 21,500 is where the highest open interest is in calls. Whereas on the put side, highest open interest was at 21,400, followed by 21,300 and 21,200. So if you look at the options data, there are multiple supports on the downside, but the resistance is very, very strong at 21,500. So in case if at all Nifty is able to move past 21,500, then max upside that we can see is 21,600. But on the downside, we still have room till between 21,200 to 300. So that is somewhere around 21,250 is what we should be testing. Now, Nifty has seen a huge rally, and for this particular up move, for this trend to continue, it is very, very important that some cool off, some consolidation does occur in Nifty. Otherwise, the trend will not be sustainable. So this is a healthy sign that we are looking at a cool off. 21,250 is where we should be looking at buying opportunities again. Eventually, this uptrend has a target of 22,000. So stay bullish. Longer term is still intact. But on the downside, 21,250 is where we should be expecting Nifty in a couple of days.
All right. And Avni, what's the view on the banking pack? You know, Nifty Bank before yesterday's fall had given returns of about 8% month to date in December. But we are seeing some bit of a weakness set in for the banking pack. It was down 0.5% yesterday, is in fact down about 0.4% this morning, below the 47,700 mark. So what are the support and resistance levels you are tracking on the banking pack?
So Suyash, again on Bank Nifty, if you notice, I mean last week when Bank Nifty did cross 48,000, yet the highest open interest continued to be at 48,000 call, which means that the call writers held on to their position. And what we are looking at is a downside trend on Bank Nifty from the resistance of 48,000. The support stands at 47,400. Yes, it's weaker of the two indices. So we should be seeing 47,400 very soon on Bank Nifty, and resistance stands very strong at 48,000.
All right. Avni, hold that thought. We'll be right back after a short commercial break.
Jyotiraditya Scindia is also facing a litmus test.
There have been corruption charges against all the chief ministers or towering leaders who were rich, but this is not the case with Scindia. So the point is that in modern times, when the society is looking up to good leaders, so Jyotiraditya Scindia could be one of them.
As far as Jyotiraditya Scindia is concerned, even if the BJP loses, Jyotiraditya Scindia will be around for at least another 2 decades. He is young and he has the ability to come back.
This and more streaming now on the world's first news OTT, News9 Plus. Download now.
They picked my husband. He was tortured there for 2 years. He was enforced disappeared. We had no idea where he is. Within 15 minutes, we got the information that the whole area is surrounded by Pakistan Army. I came out from that in disguise, and after 5 to 6 hours, I was in Kandahar. I don't have any message for Pakistan. There is no politician in Pakistan. They are puppets of Pakistan Army.
Streaming now. This and more streaming on world's first news OTT, News9 Plus. Download now.
Welcome back. You're watching First Tick here on News9, where we break down the day's action on the D Street. Now, Avni, before coming to you, I'll come to Amit. Sugar stocks are buzzing. What's the story there?
We had an erratic rainfall. The government curbed the direction of sugar molasses towards the production of ethanol way back in October. They reversed the order, and yesterday, sugar stocks shot up almost 8 to 10% in yesterday's trade. Though today they are probably witnessing a little correction. The ministry has basically allowed the juice as well as B-heavy molasses to be directed towards the produce of ethanol. Ethanol is basically used as a green fuel apart from anything else. Now, the decision to curb it was because of an erratic rainfall, and we needed the sugar in the middle of a heightened food inflation.
And there was a shortage of sugar stocks.
Yeah, so and there was a food inflation problem during that time. So there was a curb at that time, but that curb has been removed. Now, fuel retailers had floated tenders worth 8.25 billion towards ethanol production in the current season as of November 1st, and about a quarter of that production would come from the from sources that come from molasses and sugarcane juice. Now, today, of course, there's a correction. Of course, there was a jump of 8 to 10% yesterday.
I think they're all in the green now, Amit. The rally is well and truly on.
Yeah, a little bit, not as much as it was yesterday, the jump that we saw yesterday. Avni, do you think this is temporary, or can we expect an extended rally when it comes to sugar stocks?
Because Avni, we have not seen any recovery also. I think the order initially came in place on December 5. We saw big correction from there on. Yesterday the recovery has started, but we are still a far distance away from that December 5 price. So that does leave room for us, right?
Yeah. A little correction today in some stocks.
So, in my view, I think on the sugar stocks, in spite of the ruling turnover and positive news, the stocks are not reacting as much. And if you look at the technical setup of most of the sugar stocks, including the ones that are there in the FNO segment, like Balrampur Chini and and the likes of it, I think every pullback that is there is not much of a juice left in this particular sector. And in my view, I think if at all we see a small pullback, it's a good time to book out these stocks and get into momentum sectors. So not looking at a very big upside, it can rally up to around 2 to 3%, and that is where one should book out positions in sugar stocks.
All right, that's Ms. Avni Bhatt for you. Thank you, ma'am, for joining us here on News9. Always a pleasure speaking to you. But moving on, let's also look at how the markets are holding up, and from what I'm made to believe, the markets are still in the red. It's a choppy session for Nifty. Nifty is, as we speak, still holding below the 21,400 mark. It's actually at 21,370 mark. Down about 0.23%, whereas Sensex has slipped below the 71,200 mark. The broader markets are also in the green, and all the sectors in the red, and all the sectors are also trading with minor cuts this morning. But to discuss that and more, let's bring on board Mr. Rohit Srivastava of India Charts. Now, sir, I mean, Indian markets pretty much had been rallying, but the big pivot for the global markets came last week when Fed chair said that the rate cuts are now coming into view. But since then, there have been 3 Fed members that have pretty much downplayed that rate cut talk, saying that they are not even a topic of discussion right now. So I have 2 questions over here. First, what do we believe? What they were saying on Wednesday or what they are saying now? And second, is that the market running ahead of this entire the talk of a rate cut?
Yeah, you've put some very good points there, because if you simply go back to the narrative of the last few meetings, it was that this is too early to really discuss this, and they didn't want to really get into rate cuts till they were sure that their targets were being achieved. Now, what they have done here is simply use language as a policy tool, which is also something they were doing more than a year back when they were hiking rates, and they slowed it down from 75 bips to 25 bips. And then were not hiking, but were still using language by saying that we need to keep rates higher. And that essentially got the bond market continuing to fall and, pushing up interest rates in terms of bond yields. So often, policymakers will use language rather than actual actions to do something, which is sort of what I think has happened here, where Powell has, used his space to explore that and push markets in a particular direction in terms of specifically the bond market. You see, the bond market had fallen so much that the cost of borrowing, and remember that there's a huge borrowing program for the US government ahead, they can't just let it spiral out of control. So they probably needed the bond market to cool off a bit more, and that is what they have done with the use of language. But there's been no particular action in that. That is why doubts will remain on the table as to how soon this can happen. Can inflation really go back to zero or sub 2%? Will it rebound? Because there are a lot of research out there that says you'll probably not go below 2% and you'll probably stabilize near 3% for the rest of the year. That will make it difficult to cut rates beyond a point. So those are issues we will deal with, which is why I think the macro risks to markets are not gone. But in the short term, it definitely created the momentum for things to continue in a particular direction. We'll have to be watchful starting January of 2024, which is also a seasonal period where many times the markets historically have peaked, and so we should be aware of that. Keeping the entire perspective in mind that the current momentum can get pushed back, because we've had a pretty good rally. I mean, from 18,800 we are at almost 21,500 on the upside, which is pretty big, and may have discounted a lot of what has happened this month, from elections to the Federal Reserve decision.
And sir, talking about discounting a lot of these good news, another thing I think the market is discounting is that, US is heading towards a soft landing, because the Fed chair, Mr. Powell, also said that, risk at this point are well balanced. If the economy shows signs of slowing down, they'll be ready with rate cuts. So are we in fact heading towards that soft landing sort of a scenario, or recession? Is recession still on the cards?
I would like to keep it open, because there are a lot of mixed data points. I try to track a lot of different things from different researchers specific to the US market, and it's not clear whether it will be soft landing or it will be a recession. And how do we really define a soft landing? Would mean that you have a slowdown in multiple sectors, which is sort of already happened. I mean, the only place you have excess is places like consumption. Your manufacturing PMIs are already sub 50 for quite a while. Same with services. So you're actually seeing negativity in meaningful parts of the economy, but not everywhere. And that is so it's already a slowdown in that sense. But then if you go by headline GDP at 4%, you'd say, where's the slowdown? So that growth is also happening in particular sectors. So it's pretty much fractured in that sense. Will it become broad-based is what we will end up calling it, as a recession, where growth really flattens out across the board. In fact, even GDP numbers for this quarter may not be at 4. It will probably drop back to a 1, and eventually average out for the full year at a 2, 2.5 or something like that.
Good morning, Rohit. There is bond yields are cooling off. Dollar is easing. There are rate cuts on the horizon, and FIIs coming to India are back with a bang. In December alone, as you will know, they have bought almost 30,000 crores worth of equities in India. Do you expect these inflows to continue, and which are the sectors you're looking at will benefit most from this reversal of FIIs coming to India?
So again, I would not want to jump to a conclusion on what FIIs end up doing. Surely they've been selling large caps. So the easy answer is, if the money comes back, you get a good large cap rally, and specifically in banking. So that would be the easy answer if the money flow continues. I hope it is not just year-end asset allocation happening, because what happens also at this point of time, a lot of funds do allocate money in places where they need to show performance, where they may have missed out, and that leads to a lot of money flow into equities globally. We want to see whether this trend continues and it's not just temporary, because there have been many phases where you've seen FII flows into India come in and then peter out again. So I hope this is not one more of those episodes, because on a 3-year basis, this is the 3rd year where on a net annual basis, we are still seeing outflows. But we did have good inflows, sometime in May, I think, if I'm not wrong, April, May, once the rally had kicked in, and then again it cooled off and it went negative into August, September, and so on. So we want to see whether December continues into January. I think that will be critical in terms of understanding whether these flows are more permanent and not just temporary.
Mr. Srivastava, and what's the mindset of the investors that you're talking to? Are they looking at this rally as a way to build long-term portfolios for the next 5 to 10 years, or are they using it as an exit point to book profits?
So there are different groups of investors. What you're talking of is active management and passive management. I've had to spend a lot of time explaining it to people who read my work on an everyday basis, because we have gone from passive to active in the last 6 months. So I actually take that kind of a switch in terms of my mental communication. That earlier it was okay, markets are good, you're in a bull market, it'll keep on going, we're projecting 20,000, 21,000, then 25,000 and maybe 35,000, and you just stay invested for the long haul. The risk of this entire thing from the US, when bond yields were rising and the potential for a recession, which we are talking about, if I could say that certainly it's off the table, then I would do what you're saying is remain passive, just stay invested, look for dips to buy for the long term. Now that doesn't change completely, but I do feel that there are some serious risks that can show up in 24 in the new year. And for that reason, creating some level of cash at these levels is also important, because we cannot say that valuations are cheap in any case. On our platform Strike, if I just open the valuation charts of multiple stocks, whether it's a large cap like Reliance or whether it's a mid cap or small cap stock, they are all in the more than one, closer to 2 standard deviations of their historical valuation range over the last 10 years. So when you're at and I'm saying positive 2 standard deviation. So when most valuation parameters in the positive 2 standard deviations range, you know that you're buying at the top end of long-term valuations. And so the bet has to be that growth will continue to be stupendous going forward. That's the only logic that would apply to keep investing at these valuations. Otherwise, it would be an extremely overvalued market. So given that, creating cash for volatility along the way makes sense. I will not put a number on what percentage cash, but I think the rally is worth booking some gains and creating cash for future entries that you can make at lower prices.
Rohit, of all the good news, adding to a risk, there is one hiccup that has happened because of the Houthi militants in Yemen. Now, British Petroleum has become the first oil company to haul all shipments through the Suez Canal. As we know, for the viewers, almost 50% of world shipping transits from Asia to the Mediterranean through the Suez Canal. Now, my question to you is, do you see this having a long-lasting impact on oil prices, or and do you see in the long run oil companies will be factoring in militancy in their costs?
We have seen an initial reaction. The oil prices have jumped by 2% or so.
2%, yeah. But is it going to last a long time?
Yeah, see, geopolitical risks are the toughest one. I can upfront say I'm not a geopolitical expert, but the news in particular is not good. People have been waiting for a while to, get a hold on whether the situation really gets worse, along that canal. If any of the other nations step in and make it difficult for oil, then oil prices definitely shoot up, because they have been cooling off in the wake of weaker demand. So demand to supply equations were keeping oil prices down, but geopolitical risks can actually bring them right back up. So even if I think longer term, we don't really see oil prices going much below, $65 to $70 would be the bottom end of the range for oil prices. So we pretty much came close to that level. So there was anyway less downside risk. So any news that comes in from here on the positive side is going to push oil prices higher only. And we'll have to factor that in. The only thing is, do oil prices rise slowly, or do they rise very, very sharply? Because when they rise sharply, then yes, it's a definite impact on the financials of various net importers of oil and inflation. When they rise slowly, then we sort of tend to absorb that risk into the markets.
All right, that's the view from Mr. Rohit Srivastava. Sir, always a pleasure talking to you. Thank you for joining us here on News9.
Thank you.
But with that, we have completely run out of time on this edition of First Stick. Keep watching News9.
Currently, the industry is facing a lot of challenges as far as demand is concerned. Basically, that US markets has slowed down because of high inflation.
So obviously, diamonds being